Okay. Hello, everyone. My name is Chip Frame here from Nadex, and we're just about to start here. As Dan said earlier, we really have a great webinar for you today about spreads. Bob Iaccino and Mike Arnold are here with us. They're going to present for us. They're with Path Trading Partners. And I tell you, these guys have a lot of experience between the both of them. Actually, it's like 23 and a half years plus each of them. Bob, you might have seen on TV. Has had many appearances on CNBC and other networks, and Mike's been a market maker and a consultant with hedge funds. There are some slides that go into their history more, so I really don't need to go into that. And actually, we're just very lucky to have these guys here to share their knowledge. So anyway, we are planning to have a series here about the spreads. They've agreed to do that, so enough from me, so let's just turn it over to Bob and Mike and go ahead.
Thank you, Chip. I just want to make sure everybody can hear me. It's a bit of an interesting situation. My name is Bob Iaccino. Chip, thanks for that introduction. And I want to throw out there two things before we get started, actually three things. The first one being that I am in Bogota, Colombia right now. I was invited to speak at an event hosted by the Bolsa Mercantil. I hope I'm pronouncing that correctly. On Tuesday, so I'm in Bogota, Colombia right now. So if I drop off at any point, I will do my best to jump back on, but I have full confidence in Mike and his ability to handle the content mostly created by him. So that's number one. Number two, there are two bio slides on us in this particular presentation. I'm going to spend precisely no time on those. If I'm correct, Nadex is recording this and we'll post it on our website at some point. They'll have it somewhere, I'm sure. And if you're interested in the details about our bios, you can read them. I just don't take a lot of comfort in talking about myself. So they're up there, you can read them, and we'll kind of whiz right through them when we get to those. And then the third thing is, Path Trading Partners was really created. It's a new company, although myself and Mike are not new at this at all. I've been around for about 23 years, Mike closer to 25, although he's younger than me. And just a quick background of how we got into educating it all. I was approached, so I was a trader on the trading floor at the CME and the CBOT, and I was approached after I left the floor by some of my old friends from the trading floor who was struggling. I left the floor in late 2002, and I had to reinvent myself, so I learned how to trade on the computers for myself, and it was an arduous process. It didn't happen overnight. It was extremely difficult, even for somebody who had as much experience as I already had. And learning to trade upstairs was, again, not easy. A friend of mine on the trading floor that I helped make the adjustment said, well, this sounds like something we should be doing as a business. So I started teaching. Mike came into one of my courses as a student, and he actually attended a live event that I gave in Chicago, and he approached me on one of the breaks, and he said, I've learned some of your stuff, and I think I've improved on it. The reason I always tell this story is I don't ever want to come across that our experience in trading and in teaching other people how to trade means we know everything. Quite the opposite. Mike and I don't think that way. So when I had a person who I assumed was a student, and only a student, approach me and say, I think I've improved upon your methods, I was quite eager to see what he did. And he did. He did improve upon the methods that I was already using. So I asked him to join the little firm that I developed. But Path Trading Partners is specific to Nadex. We are separate from Nadex. We are completely separate entities, but we developed Path Trading Partners and essentially just launched it to help Nadex get the word out and take some of the techniques that we have used in other markets and show them to people and how successful they've been with Nadex spreads specifically and certain things in binaries as well. So I'm going to move on to the next slide, which is something we have to get out of the way. A quick risk statement. This presentation is for information purposes only. How bored are you guys with this part? But this part's very, very important because actually, if you don't believe the things in this risk statement, you should drop off, and I can explain why in another time. But this presentation is for information purposes only and does not constitute investment advice, nor an offer, solicitation, or recommendation to acquire or dispose of any investment or to engage in any other transaction. This presentation is not intended for solicitation purposes, but only for use as general information. All descriptions, examples, and calculations contained in this publication are for illustrative purposes only. The risk of loss in trading can be substantial. This is the part that's real. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition. Past performance is not indicative of future results. I always talk about these last few lines because I think people think this is just kind of CYA stuff, just like covering your butt. You have to have a risk statement out there. But you really should decide before you start trading how much you can lose. Okay, and that's not to say that you're going to lose, but the risk of loss is real. The risk is the counterbalance to the reward in trading. It's a zero-sum game. This is a bunch of complicit adults who get involved with the idea of one trying to take their money from the other. That's what trading really is. So if you think that you can get into trading by just a couple of quick steps or a couple of quick lessons or a couple of quick indicators, that generally doesn't happen. So people should always have an understanding that there is risk involved in trading. All right? Just because I say something's going to happen doesn't mean it's going to. Just because Mike says something's going to happen doesn't mean it's going to. We've been doing this for a long time and we've survived in it. So we think we have sort of a good angle on high probability situations. But I've had losing days, losing weeks, and losing months. Everybody has. So just wanted to cover that as opposed to just gloss over it. So we can go to the next slide now. By the way, this completely unprofessional thing where I'm saying go to the next slide, again, is because I'm in Colombia, so I don't really have any control over this. So Path Trading Partners is a trading and education firm. We are real traders. We do trade. And down the road, we're going to have some unique offerings, I think, that you haven't seen in binary options before, but we'll get to that another time. PTP's mission was to form a trading firm that educates, supports, and backs traders who are committed to probabilities, discipline, and long-term trading success. I like to say all the time that the best way to trade over the long term is to trade for a long time, and to have this sort of view where you may lose on this particular trade or this particular day or this particular week, but you're equanimous about your emotions. You know that, again, losses are the counterbalance to gains. Risk is the counterbalance to reward. They're inexorable. You can't do one without the other. This long-term success is achieved by following the correct path. We are not high-frequency traders, not in anything that we do. We are not day traders in anything that we do. Now, the very short-term nature of the Nadex spreads and binary options changes that a little bit, but still you're going to see, if you stick with us over this short journey of webinars that we're going to do over the next couple of weeks, you'll see why this philosophy still fits in, and as a matter of fact may fit in even better with Nadex products than with the regular products that we traded in the past. We are a firm that believes in a long-term success in trading, covering time frames dictated to us by products, markets, and price action. In other words, we don't trade search. We don't say, I really want to be long gold and look for a long. We don't say, I really want to be short crude and then try and find something that allows us to be short crude. We let the market tell us what to do. And again, over time, you'll see how we put that into play. So again, this is Mike's slide, 23-plus year market veteran. That is Mike. He's younger than me. I think I'm better looking. We can judge that later. We've been teaching traders online and in person for 10-plus years. Again, Mike joined as a student, and then I realized how much I could learn from him. He works on strategy, and he's a development consultant to multiple hedge funds. He's a former options market maker on multiple exchanges. He traded in Chicago, New York, Switzerland, Canada, and he's the current head of technology and trading system development for Path Trading Partners. The interesting thing is Nadex obviously is an options exchange, and Mike has been involved in actually setting up exchanges in other countries, options exchanges. So he definitely has an interesting take on all these things. The next slide is my bio. Again, you can just, I'm not going to read this thing. It's ridiculous. To sit here and talk about myself is just silly. This is being recorded, so you guys, again, will be able to see and read this if you want to. Yeah, that's fine. We can go on to the next one. I don't need this.
Are you sure, Bob?
Yeah, I don't need to do this.
See, nobody realized I was actually here until now.
No, I know. It's that's Mike talking in the background. People already think that I talk about myself too much. So let's go on to the next one. So what are Nadex spreads? Now, there has been webinars and there are offerings on what Nadex spreads are. What we're going to focus on is really how they're constructed in these webinars that we're going to do over the next couple of weeks, and how you actually have to look at the spreads to understand them, not just to trade them. You can just go trade one tonight if you want to. We're going to try and get to the things that I think other people leave out in terms of the construct. Other people out there are teaching very good stuff on the spreads. They definitely are, and it's stuff you can use. We always believe that understanding what you're doing is more important than beginning to do it. If you understand exactly what's going on with the trades you're putting on, then the method that you use to trade the product you're trading, it becomes much easier to understand, and you can select methods with the level of knowledge that you otherwise couldn't. So Nadex spreads are built on floor and ceiling levels that define the lowest and highest values which the trade can settle. They have defined maximum reward and maximum risk. They have multiple short-term time frames in which to trade, and there's benefits of that. There's a lot of benefits to that, as a matter of fact. You have the same limited risk, and we're going to talk a lot about that in these 4 webinars, but you have the same limited risk that you have with the binaries. You have the same limited reward. I'm going to spend a lot of time, not just in this webinar, but in others, and I've written about this with Nadex as well, as to how important limited reward actually is for traders, whether they're new or intermediate. Having a limited reward, it might sound like a complete oxymoron, but is so critically important to your long-term success. I can't stress that part enough. You have multiple spread options, multiple time frames. So let's touch on limited risk a little bit. So it's limited risk without stops, exactly like the binaries. You have protection from extreme volatility and market spikes, again like the binaries. The shortcoming of many traders when they begin to trade is limiting their risk. Now again, this sounds like, you've heard this before from other people, but one of the biggest problems that new and even intermediate traders have, when a new trader becomes an intermediate trader, sometimes the thing that happens to them is they think, okay, now I've got it. All right, and they start to get this idea that they're right and the market's wrong. That happens in the beginning. It's more about fear. It's more about fear of taking a loss. But then when a new trader actually advances into the intermediate level, they get this sort of idea that, like, okay, I've made it. I got it. I get it. My method is working. I'm getting high probability trades. I'm getting risk. And then they start to think that the market is wrong and they're right. There's a whole interesting side of psychology that we can get into about that, about not attaching the result of the trade to your self-worth. But again, we'll do that another time. But the shortcoming of many traders, both new and intermediate, it even affects, to a certain degree, professionals, but not as much, is limiting risk. And Nadex products prevents that from being a problem. So obviously you have no need to crowd stops. And again, these are things you've heard both in webinars about binaries, and some of the webinars have already been done about spreads, but you don't need to work with stops. We've got ways of limiting the risk that are built into the product. And you have no risk of margin calls or losing more money than is in your account. Okay, and that again is very key, because if you have, one of the things we talk about with traders all the time is when you're going to start trading, open that account with an amount that you can comfortably lose. There's a little story that I tell all the time, that the first time I started trading for myself was in the pit. I had worked down as a, you've heard this a million times, Mikey. I was working down on the trading floor. I borrowed money to go into the pit and actually start trading, got my membership, and I promptly lost approximately $97,000 in less than 8 months, mostly because the market was wrong and I was right. Obviously, that's not the case. The market is always right. But I lost that money, and my wife, who's now my ex-wife, of course, that has a lot to do with it, the problem that I had was not being able to accept that sometimes the trade I've chosen needs to be cut. I need to get out of that trade. We teach a lot, and you'll hear this a lot, that if you use a particular methodology, right? If you use a high probability methodology to enter your trades, okay, you'll have times where you win and times where you lose. There is no 100% winning methodology. There's very few 90% or 80%. Those are rare as well. So getting your mind around the idea that you need to cut trades, again, is the hard part, especially if you've gone through a losing streak. And again, the limited risk part of the Nadex products is one of the things that drew us to want to sort of team up with them and get some of these things out there, because it just makes it, like Forrest Gump said, it's one less thing. So I'm going to turn it over to Mike now to go through some of these examples, and I'll talk to you guys again a little later in the presentation.
All right, thanks, Bob. Hey, everybody. Glad to be here. Again, as Bob said, this is just the first in a series of these, so we'll be elaborating on a lot of these concepts over the next few weeks. So this is more of an intro and a background to spreads, and we're briefly going to touch on some things that we're going to really dive into in future presentations, so you're going to want to be watching for those. But just as Bob was saying, this is one of the brilliant things about trading the spreads, especially for newer and intermediate traders. You don't have to crowd your stops, which so many traders crowd stops. They think they're really limiting their risk by keeping really, really tight stops in trading other products, whether it's stocks, whether it's futures, whether it's forex. So they're trading, the underlying, they might be trading the S&P or whatever they're trading, and they keep really, really tight stops. And what they don't realize is, yes, they are not going to have, for the most part, big losses unless their stops get run or we go to fast markets or other conditions, which can and do happen. But what they're actually doing is costing themselves more money because their stops get picked off a lot. They get stopped out more than necessary. They don't give the trade any room to breathe. They think, I'm going to be right exactly on my entry, and the trade's just going to go in my direction. Now, one of the great things about these Nadex spreads is, you don't need to crowd your stop. And yes, there'll be times, and we'll go into other strategies in the futures where you're not always getting in at the floor or the ceiling. You might be getting at the midpoint. You might be trying to capture premium and actually capture the time decay, so it's going to appear that you have larger risk to your reward, and therefore you might be exiting a spread early, and whether it's going to your target early and you take your profits early, or whether you cut, let's say it goes against you and you cut your loss early. But for the most part, let's just look at this example where a trader, let's say you have two traders, and it doesn't matter what market this is, we actually strip the markets out of this just so people can just focus on what's going on with the price action here. One trader's trading a Nadex spread, and one trader's just trading the underlying, whether it be crude oil or the S&P 500 or the 500 spread from Nadex, which mimics the S&P 500, or the Dow 30 or whichever spread you're trading. One trader gets in, they get in around this level where just arrow is, and let's say I'm trading the Nadex spread, my target's up near the ceiling. And we'll also in future webinars get into how you're going to determine targets, and then how you're going to pair your spread up, and do you want your target to be right at the ceiling of the spread? Do you want your target to be on the ceiling of the spread, and reasons you might construct them in different ways, and how you're going to choose different spreads based off where your targets are. But for now, let's just say our target's up near the spread ceiling. So I'm going long here to spread down by the floor, and the market's going up toward, hey, this is a great trade. It's going up towards the ceiling. Oh, this is no brainer. And all of a sudden we have something come out. Maybe it's a surprise announcement. Something happens in the market. And all of a sudden we collapse back down. We collapse. Well, if I was just trading the underlying, and I had my stop down here by this orange line, down below recent price action. Okay, I got a decent stop, maybe even slightly below that. If I'm just trading the underlying and my stops in the market, this collapse takes me out. It hits my stop before it got to my profit. So this turns into a losing trade. Now, if something like this happened, and you're in a Nadex spread, yes, these profits went away, but this spike did not take you out of the trade because you do not have a stop. Your loss is limited to, again, what you paid for. So even if this goes below your floor price, your risk is already defined, okay? Which is great because these kind of things happen to traders, and especially when they, as we talked about, crowding their stops. You're trading the underlying, your stop gets taken out, and then the market, as a lot of these things happen, especially on these quick moves, and we've seen them a lot over the last couple of years, you'll get these quick reversals, and then it'll snap right back. So a spread trader, yes, it went against them, yes. Profits disappeared, but then it snapped right back, and it ended up going to the ceiling. This is an example of, and whether it got to the ceiling or not is really irrelevant. The whole thing we're trying to show here is that you do have limited risk, and not through the use of stops. The nature of the product, the nature of the brilliant thing by trading these Nadex spreads is it's limited by the way the spread is constructed. And we're going to get into in a future presentations exactly how these spreads are constructed and why they have the characteristics they do. And once you really understand that, your light bulbs are going to go off, not only in just the risk-reward level, but you're going to see all these new different ways to trade these things that you might have never thought of before. And as Bob said, I was an option market maker, and we used to construct spreads all day long. And we used to have retail traders come in, and as a market maker, people might ask you to construct spreads. They might say, I want a spread in XYZ stock, and you're constructing a bull spread or a bear spread, a call spread or a put spread. Well, Nadex has already done that for us, and we're not even referring to them as call spreads or bull spreads or bear spreads because they're spreads. And you'll start to see how where you put on the spread you can tailor it to what kind of market conditions they are, what kind of volatility it is, what kind of momentum the market's trading with. And you can really see how these things can be very versatile beyond even this slide that we're going into now, which shows you the brilliant limited risk of the spreads. Now, Bob also touched on limited reward, which for a lot of traders sounds counterintuitive, or it might seem like an oxymoron. A lot of traders don't trade with targets, and they would be much better with trading with targets. Targets help for a few reasons. They control greed, all right? Especially when a trade starts going your way. And all right, if you have a target in place beforehand, you already have designed the trade. All right, I'm getting in here. If it gets to this level, I'm getting out. That is a great way for most traders to trade, because as the trade starts going their direction, they already have a predefined plan. They already have a roadmap of what they're going to do. When you don't have the roadmap, your emotions can take over. You can start saying, well, geez, all right, it's already going in my direction. Oh, yes, yeah, it's, all right, it's going to keep going. I'm just going to hang on a little more because, you know what, this is going to be this really big winner I've been hoping for. Well, logic and systems go out the window a lot of times when that happens. And then traders maybe take nice winning trades and turn them into losing trades, or they do crazy things. Targets help control that. And one of the biggest setbacks for traders are emotions, the fear and greed cycle. We've already gone on that limited risk. If you know, back to just that limited risk thing real quick, if you already know, hey, I'm going in the spread, and you know my risk is the $40 or the $60 or whatever I originally bought the spread with. You've accepted that risk because it's now you've taken that money and you've put it on. And you don't have to, all right, it's starting to go against me, or you watch it collapse like in that last slide. Your risk is already accepted. Well, on the counterpart, you can also, once you have a target, you can design the correct spread based off your target. And then if it's going to your target, it's a predefined way. You don't get the greed emotion in there. And it really helps. So the spread naturally creates a target, and you're going to learn how, through generating your own targets, you can pair it up with the correct spread, and then you have the best. You have your limited risk, you have the target that helps you control your greed. You also have a great thing that a lot of traders don't do as beginners, which they really should, is it gets you to focus on reward and risk of your trade.
If I could, Mike, one of the things I wanted to throw in about limited reward, because all of you that are in here right now obviously have been involved or are thinking about getting involved with Nadex, with this particular exchange. Nadex is an exchange. And one of the things about limited reward is if you're here, you see some sort of value to limited reward. Maybe in the past you've struggled with the idea of taking profits and cutting losses, and most of you probably got into it around the time that you got stopped out of things. The example that Mike showed with that sort of big spike down and then a rally back up, most people that come into binaries, come to Nadex, have experienced that, have heard about that, or just don't want to experience it in the first place. But there's all these trading, what would you call them? Trading, to me, they're trading myths, right? And one of those is that trading with targets goes against the traditional idea of letting winners run, and it doesn't. So in our other education where we teach stock trading and futures trading and things like that, we have to try and convince people that a target doesn't necessarily mean you exit the trade. And you'll see when we get into our actual courses, if you decide to join us, that we're going to actually have trades that you exit before expiration, before it settles, before it even reaches one of the already built-in targets. Those will be certain strategies that we use. But trading with targets has been one of our sort of missions to get out there, that a target doesn't necessarily mean you cover your entire trade. All a target is a price point where an action needs to be taken. Nadex does that for you. And in the spreads, there's a floor and a ceiling that do that for you. So for Mike and I, we got really excited about educating here because we're able to say, okay, here's one of the biggest problems we've had getting people to understand built in for us. So, and Mike's got an example that he'll go into now.
All right, and we already touched on the trader can define reward and risk when they get in the trade, which is really beneficial for traders. So let's take a look at the limited target trade example. All right, now a trader, in this hypothetical example, is going to enter in a spread breaking out. We sort of have a horizontal channel here. Imagine a line going off of here. We've been trading range bound, and they're using just a simple strategy called a measured move on a 15-minute chart. So we're breaking down through this. They have their target based off the 100% of a measured move. And if you don't understand a measured move, we can go into that in a future session. It's a strategy that a lot of people do to come up with targets. And it's very valid, especially breaking out of horizontal price channels or even doing retracement trades in trending markets. And there's different types of measured moves. A common one is 100% of the move. So essentially, we're taking this high part of the channel, this low part of the channel, and the retracement to the mid part of the channel, and then we're projecting out that if it breaks out of this channel, that's a pretty good target of this. So a trader now could be trading a spread on the short side, getting the spread short, and they are looking for something with a floor, since they're going short the spread, a floor down by their target, preferably in front of their target. And we will get into why that would be in future classes. But at least this trader has a target, and they've clearly defined it. So they know where they're getting in. They're getting in when it breaks out of this channel, and they also have the target. And since they're using a Nadex spread, they also know, based off since they're going short, the ceiling price would limit their risk on this trade. That doesn't mean if this trade starts going against them, they're going to hold it all the way until it reaches the ceiling price, depending on where they get in on this spread. But they have all the components we've listed. Limited risk, a target, they're choosing a correct spread based off of their risk level, based off of their target, and they know what's going to trigger their entry into the spread. So the market goes down to their target. Now, why is it, if you didn't have a target, what happens to a lot of traders? Well, they watch it go down there. Oh man, look at this. It collapsed out of this range. This thing's going. This one, I'm gonna, yeah, I knew what my target is, but look, I get this big, huge red bar. Look at these big red bars breaking down out of this. This thing's gonna keep going. I'm gonna let it ride. You know, I'm not taking it off. I'm gonna let it ride. A lot of beginning or intermediate traders will try to do that. Then what? See, this is why we have targets. Now, this is a great measured move target, and look then what happened. It bounced back, then it strongly reversed back to the prior breakdown level. So this is where, if you didn't have the target, if you didn't have a spread defining the target, hey, it got to my target, I'm unwinding my position. I already predetermined it. You know, I predetermined based off the momentum of the market. I chose the right spread. It got to my target, I unwound my trade. That target made sense. It was based off a measured move target. And look what happened. It had a strong reversal. Well, the trader that didn't have that target or wasn't in the spread to capture that target, all right, they were going for their greed thing was kicking in. And now they've watched their profits. It's now back to above where they entered. They had a nice winning trade turn into a break-even or a losing trade, and now they're running a bunch of emotions with fear, with greed. They didn't follow their plan. They had their target based off of a logical market sort of system. Okay, a measured move. We used it. We combined it with the spread, and we traded it using the benefits of the Nadex spread. So that's one of the reasons that targets are so great. They can help a trader control their emotions, control that greed. They've predefined the trade. They've used the Nadex spread to define, in this case, the floor of the trade where they're getting out of the trade. It already reached its target. There was no point to sit there and hope it kept going. You know, I've reached a lot of my profit potential, and depending on when the spread was going to expire, you know, and we'll go into that in a future webinar, which how time decay on the spreads work and how you can capture premium and why you want to choose certain targets based off time decay and the momentum of the market. That's for a future class that we'll get into. And I'm just letting people know that now, because these are all the things that when you get out of these series of presentations we're going to be giving you, you'll understand these nuances more and more, and it will help you whatever method you're trading now, whether you, hopefully you do have a method that you're trading. Just the stuff you're going to be learning in here will help you fine-tune and tailor that method and be able to use these spreads in a more constructive manner. Okay, so here's another limited target trade example. All right, and we use one of our stuff we use a lot of GAN levels. These are GAN boxes. Not a lot of people know about them. I actually prefer them more than Fibonacci. They're an aspect that you can easily, if you know Fibonacci, if you use Fibonacci levels. I prefer the GAN levels. Here, a trader went short at a 50% GAN box level. Here we have another price projection at 12.5% price GAN box projection level, and we can get into something like that down the road. But here's another target. The trader gets in the spread short here. They have a clear defined target. This 12.5% is a very reliable, when you're trading GAN box levels, a good first target. So if they designed a spread and found a spread that had a ceiling or a floor near this level, not beyond it, you'd want, because you have a target, you just want your target to be at or preferably even in front of this this target here, because then as it goes to your target, you're actually getting the full benefit of the spread. But you have a target level, and again, it was predefined ahead of time. The trader knew that this is where they wanted to be taking their profits. And it got to that level, they took their profits, and then we had a strong reaction. If you don't have a target, again, you see the trade collapse down there, and that greed can kick in. All right? And it happens to a lot of traders. All right, so a great thing also with Nadex spreads, you have multiple spread options. And one of the things you're going to be learning with working with us in these free webinars we're doing is, do you know which spread to trade? There's multiple spreads, and there's, you know, the intraday spread, there's the 2-hour spreads, and a new one pops up essentially every hour. There's the, like in the US 500, there's an 8 a.m. to 4:15 spread, it's a little wider. There's a daily spread. Do you know which of these to trade and why you'd be trading them? Do you know the characteristics of them? Do you understand how the underlying moves, when the underlying moves 1 point, that the spread, until we get close to expiration, is not going to move point for point? And again, it's because they're constructed from options, and options have the Greeks with them. You know, options have delta, gamma, theta, vega. And we're going to be getting into all that and show you, once you understand the Greeks and the strategy you're trying to trade and the market characteristics, hey, based off these multiple characteristics, or this time of day, which is low volatility, or this, we're coming off a high volatility time, volatility was pumped up in these, and now the report came out, and now volatility is going down, but we might have a high momentum environment. I want to put on this kind of spread, and I want to put it on at this point in the spread. Do I want to put it on near the ceiling? Do I want to put it on the floor? Do I want to put it in what I call the null zone, which is essentially you're not paying premium? So in certain market conditions, you'll want to put it on close to the middle of the spread, given certain market conditions, and you'll want to then use a longer-term spread since you're not paying a premium to do that. And people might say, oh, look, I have more perceived risk. Well, you might not then hold the spread if it goes against you all the way until it hits the ceiling or the floor. But all those things we're going to go over. But you need to know which spread to trade. There's a lot of different options here. And you can tailor these spreads because they give you so many different options. You can find the correct spread given your trade and given the market conditions that best fit your strategy.
This is about where I like to point something out on this slide. All right, this is where I start to look at the number of attendees in the webinars and see if it's dropping or if it's increasing or staying the same. And the reason I say that is because if you're going to trade Nadex spread, and honestly, I think every single person listening to this webinar and every single person that potentially listens to the recording of this webinar for however long the recording of this webinar is up, okay? How many people drop off after these next couple of slides? If you look at this particular slide, you'll see there's a 1975 to 2005 floor and ceiling in the US 500, and then down on the bottom there's a 1945 to 1975 floor and ceiling. If we're at 1975, do you want to buy the spread above? Do you want to sell the one below and take in premium and watch it sort of decay depending on the time? Do you know when to do that? If you are using a method that tells you when to do that, I have no problem with that. As a trader, again, of over 22 years, I have no issue with having a method or a system or an indicator or something that tells you when to get in and out of things. But do you know which one to get in and out of? Do you know how the volatility and the Greeks that Mike mentioned will affect these things? There's a lot of people that think that you can just trade Nadex spreads based on floor, ceiling, and center point, and that's simply not true. Do you know what Mike means and understand what Mike means by the null point? If you don't understand what you're trading, it's like taking a prescription drug that you don't understand what the side effects are. Some people will take whatever their doctor gives them. I won't. There's certain medications I will ask what the side effects are, and I'll choose if my situation is worse than the side effects or not. That's because I want to know what's going into my body, and I want to know what it's going to do to me. To trade something that you don't understand the inputs, and Mike mentioned light bulb moments. I like to tell this story. When I first started down on the trading floor, I had to learn ARB, right, the hand signals, to be able to flash orders back and forth. And for a long time, I had to think to do the right hand signal. And then at about the 6-month point, I put an order into the Eurodollar pit, and I didn't have to think about it. My hands just did it. That's where we want you all to be. Every single person listening to me right now has the intelligence and the basic math skills to know what we're going to teach in these webinars and in our courses. And if you have just a couple of hours a day or a week or a month to commit to grasping how these things are constructed, these are going to be your core trading product. The spreads is going to be your core. You're still going to trade binaries, of course. But we've looked at this, and this is the closest thing to professional trading with the safeguards in place that we've seen. These products are amazing, but if you trade them without understanding them, you'll put on a couple of trades, you'll win some, you'll lose some, and you'll move on, and you won't get to where you want to be. Can you put the next slide up, Mike?
Sure.
Here's another great example. All these different time spreads, and the different floor and ceiling differences from 150 points to 300 points. Which one is the best one? If the underlying, there's overlap in all the spreads, and if the underlying is in an area where there's overlap, which one is the right one to do? It isn't always the one at the floor. It isn't always the one at the ceiling. And believe it or not, it isn't always the one based on your method for finding the trade in the first place. It isn't always the one at the null point. There are different times and different situations to put these things on. And the Greeks, the way we're going to teach them for the spreads, are not intimidating. I promise you they're not. For typical options trading, for conventional options trading, they get a little complicated. Okay, I think in my 23-year career, I've traded 15% options, 85% underlyings, because some of these things just got too complex. Nadex takes this out, but you have to understand that they don't react the way you might think. They don't react exactly the way regular options do. On the next slide, Mike's going to go into that.
Okay, so as a trader, you need to understand what you are trading, and Bob just alluded to that. And the more you understand what you're trading, the more you're going to have those light bulb moments, and pretty soon you're going to get like Bob with the hand signals. 6 months in, it all clicked, and it's not going to, look, it's not going to take you 6 months in. But the more you stick with us and start seeing this stuff, light bulbs are going to go off, and you're going to look at these spreads, you're going to go, oh, all right, we're in rising volatility, high momentum. Here's the kind of spread I want to be in. And I know this is my target. Here's exactly how I want to construct my trade. I'm going to take advantage of this. I'm going to take advantage of these Nadex spreads, and I'm going to put this trade on. And I've designed now. I've taken their range of spreads, and I've picked the correct one for my method and the market conditions. So I've given myself the best possible chance of being successful. Does that mean every trade is going to be successful? No, there's no such thing. Okay, we all have losing trades, but we can at least position ourselves to be in the highest probability situation we can. And that's not just to say a system, because systems have different probabilities. And you can trade a really good system, there's some mediocre systems, and there's some bad systems out there. But even if you have a really good system, pairing it up with the correct spread based off the market conditions, understanding, you know, how the deltas work, the thetas work, the vegas work. All right, okay, we're in an increasing volatility, or we're in decreasing volatility. All right, time's always going against us, but sometimes, you know what, I can capture premium based off where I put the spread on. All these things you're going to understand. It's not just understand the underlying, okay, but you're going to have to understand how the spreads relate to the underlying and how the spreads relate to the market conditions. You're going to understand how the spreads are constructed. And you're going to realize one of the greatest things that I don't know, there's probably somebody out there who teaches it, there's some brilliant option guys out there, but one of the things you're going to learn is why we don't need to refer to them as bull spreads, bear spreads, call spreads, or put spreads. They're Nadex spreads. Because you're actually going to learn that calls are puts and puts are calls, and we'll get into that in a future thing. And just the aspect of, you're going to understand why it actually doesn't matter, and why we can just call a spread, and how you can take advantage of, and you're always going to trade these as debit spreads, but you can take advantage of aspects of premium capture. You're going to get all that. You're going to understand the nuances and characteristics of the spreads. You're going to understand why they don't move one for one with the underlying. You're going to understand how the delta increases depending on where you are in the spread as the time gets closer to expiration. You're going to understand how volatility pumps it up near the floor and the ceiling, and how that affects the spread. And once you realize those things, you can really fine-tune your trading, and it's not that hard to learn, but it can take trading these spreads and turn what is already a great product into a fantastic product for, I don't know a trader who wouldn't benefit from trading these things once they understand the nuances.
Mike's going to show you a slide, and as soon as he's done, here it is. Okay, this particular graph, you will all understand this when we're done. You'll understand exactly what this graph is. Okay, you'll understand what the different lines mean, and you may have days where you put on identical trades and they act completely differently, and you will know why. Go ahead, Mike.
Yeah, this is just an example of how a spread changes over time, and we'll get into this with theta and time decay and everything else, but how the characteristics and even the shape of the curve changes over time. And then you'll understand how this curve gets modified by different volatility conditions and by the different durations of the spreads. And you'll understand what we mean by the null point, where you'll understand intrinsic and extrinsic value of these spreads. You'll understand why, depending on certain conditions, why you might not want to put it down here. And this is just a hypothetical spread, a 100, a 105 floor ceiling spread in a hypothetical market. But you're going to understand, a lot of people look at these spreads and say, oh man, look, I can put this on. I can go risk $10 with the possibility, because they call up the Nadex window to enter in your order, and they look at it. Well, if I bought it here, I can risk $10 and I can make $300 or $290 because it's a 30-width spread. But you're going to also realize that maybe that's not the best trade for you. Maybe that's actually, given these market conditions and given where your target is and where the support in the underlying market is, why that could actually be a really poor trade. Yes, it's got fabulous reward risk, but your probability of you ever making that $290 is 0.1%. So that's probably not the trade for you. Whereas if you put it, you chose a different spread at a different point, yes, you might look at it and go, well, now my risk is 150 to making 150, but your probabilities of that trade are way over 50%, and you actually have a better outcome, and you will understand why you're looking at the maximum reward and maximum risk. That does not necessarily define the risk and reward you're actually taking in the trade. You're going to understand that based off the time decay curves, based off the volatility curves, based off of where your target is, based off, again, support resistance or where you want your stop to be. Okay? The great thing is you can trade these spreads and say, look, I might be getting in, and it might say I'm taking $150 of risk. But you actually are using this curve to your favor. So if let's say you're going long something and it starts going against you and you realize the trade was wrong, you're actually taking the benefit of this curve. You're actually using the nature of the curve to your benefit. And yes, the underlying maybe drops 10 points, but your spread only dropped like 5 points, okay, because of the volatility conditions. So you actually use that to your benefit, so you actually limited your loss even more than just the defined risk. You also know that, hey, if something horrific came out in the market, or there was a surprise rate hike or a surprise whatever, or there's something bad happens in the market. Worst case, and this may never happen to you, but worst case, look, if the market were to go like, let's say, the S&P dropped 100 S&P points, and you're in a spread trade, yes, you're gonna lose the difference from where you entered that to the floor if you went long. But you've actually captured the lot. Where somebody who's trading futures go fast market. You know, I've seen this happen, especially when we've had a couple flash crashes. Their stops got run so far, they thought they had, $300 risk on their trade. By the time their stop was run, they were filled in fast market, they were down $2,000. That's not going to happen to you trading these spreads. You know what your risk is, and yes, you might plan on risking less than that, but let's say some catastrophic thing happened. You still know you're covered. You're not going to get that margin call. It might have cost you a little more than you want, but you're not going to get that margin call. When other people are crying, you're still fine. And you've also learned how to, in normal market conditions, use these spreads to your benefit and really limit your risk based off the characteristics of the curves of the spreads. And this is just one of the types of charts. You'll be seeing all different ones of these, and you'll know how to read them and interpret them. Bob, do you want to take this over? Maybe Bob's not. Bob, are you still here?
I'm here. Colombian
Great.
Wi-Fi. Colombian Wi-Fi. They got great coffee and terrible Wi-Fi. Look. We're not really giving you the tools to trade spreads today. We're also not selling you anything, and those are both very deliberate. Okay. Nadex is an options exchange, all right? And I'll explain why I said that's deliberate as soon as I run through this conclusion slide real quick. So the North American Derivatives Exchange is an options exchange. It's a regulated exchange. And it is the best opportunity we have found for traders, new or novice, in option trading to understand the basics of options. Not only will you understand the spread options that Nadex offers, you're going to understand basics of options that Mike has been trying to teach me for 10 years, and I still don't fully get, because these things are the core of option Greeks. They're the most. You're going to learn the most important Greeks in a simple format. The Nadex spreads are at the core of this opportunity to learn these option basics. Now, the key to trading them profitably, again, is to understand what you are trading. All right. That is the most important thing in any trading endeavor, not just this one, okay, in any trading endeavor. That is the most important thing, is to understand what you're trading. Again, very similar to understand the pills your doctor wants you to take and what they're going to do to you. So remember, as with all trading, there is a risk of loss in trading Nadex spreads. We want to express that again. We are not blind to the risk in any sort of trading, conventional or otherwise. So if you continue to tune into these webinars to learn all the ins and outs of trading the Nadex spreads, you will get a knowledge that I don't think anyone else is out there teaching yet. Okay? I don't think anyone's explaining to you guys, because essentially, if you look at the floor and ceiling of the spreads, you can just glance at that, and it's less intimidating than regular options. Binary is less intimidating than the spreads. Spreads less intimidating than traditional options. But I'm telling you guys right now, as I mentioned earlier, each and every one of you has the ability to understand how the Greeks affect the spread options, and you'll understand characteristics of options and Greeks that we really couldn't teach you if we were teaching in conventional options. So this is what I'm so excited about. And if you continue to tune into these webinars, we've got another one next week. All right, and again, not selling you anything here, not trying to get you to go trade anything tomorrow, because we didn't really give you anything to trade except the basics of options you can get, of spreads rather, that you can get somewhere else. Okay? But one of the main things we want to get you to understand is the importance of understanding the spreads before you dive right in. Because I think you guys are here because you want to be professional traders. I think you guys are here because on some level you want to either augment or replace income. This is an amazing opportunity to do that with these spreads. It's an amazing opportunity. And again, we sought out the partnership with Nadex in terms of allowing us to talk to you guys. So tune in to the next webinar, which I think Nadex can tell me, but I think it's next week. I don't remember if it's Tuesday or Thursday. And we're going to actually start going into how the spreads are constructed. Again, extremely important, how the spreads are actually constructed and the way that they work during the course of the trading day. We're going to have an introduction to options, all right, to just options in general. We're going to get you to understand buying and selling premium. Now, that's something that if you're already trading spreads, you may not know yet, you may not understand yet, but understanding buying and selling premium is something that I think people kind of go in blindly, right? They don't understand that you can actually sell premium, even though everything, every part of the Nadex spread is debit. All right, when you put on a Nadex spread, buy or sell, your account gets debited. But still, you're going to be synthetically selling premium. We're going to talk about vertical spreads, what they are and why they apply to the Nadex spreads. We'll touch on the other spreads a little bit, but we're going to focus really on vertical spreads, and we're going to talk about the benefits of Nadex spreads. These next 4 webinars we do for you guys, I don't want to oversell just attending these, and you shouldn't feel oversold because they're free. So again, we're not here trying to say that you should, buy this, buy that. These are free. These webinars we're doing for you guys are free. We hope to continue to do them. So tune in next time and get all these things done. If you head over to Path Trading Partners, you're going to find a button to sign in. We'll also send you a free white paper we wrote on the 5 things that professional Nadex spread traders are doing already or should know, written by myself and Mike. We'll send you that for nothing. Again, you go to pathtradingpartners.com and just enter your email there and we'll send you that. But otherwise, again, if we see a lower number of attendees in the next webinar, we'll know that we intimidated the people that probably don't want to be involved in spreads in a real way anyway. All right, and that's not reverse psychology. If you're not willing to put in the time to understand what you're trading, no method you buy, subscribe to, or learn in a book will help you long term. And the long term part of what I just said is the important part. So throughout this, we have not been able to see any questions if you type them in. We're happy to take them now. I'm happy to stay for the duration to get as many questions as applicable answered.
Yeah, Bob, can you hear me okay?
Yep.
Okay, perfect. We did have some questions about your reference to the option Greeks, basically the complexity of regular options versus really the simplicity. If you kind of go over the delta theta gamma, and show why that makes sense. And we've got some more after that.
If you could just briefly go over, just in 2 sentences, what each one is and why the main 2 matter more in Nadex spreads than in traditional options.
Well, again, you have all Nadex spreads because they're constructed through, there's essentially an option vertical spread. You have a delta, which is the rate of change of the spread, and I'm going to put it in spread terms instead of option terms. It's the amount of change that the spread will go based off every point change in the underlying. So if you had a delta of 50 or 0.5, if the underlying increases by $1, your spread's increasing by 50 cents, essentially. You have your gamma, which is the rate of change of the delta, which is not as important for these, but we're going to go into it. So that is if the underlying increases by $1 and your gamma is 10 cents, then you know that the delta will increase by that 10 cents. So you'll understand how the underlying will affect the gamma, which then in turn affects the delta. So you'll know when your delta is increasing and when it's decreasing, because your delta does not always increase. It can also decrease. You'll understand theta, which is time decay, okay, because your spreads, especially if any of you have traded them before, if you've put them on at the floor, if you're putting it, you don't get to put it on for free at certain spots. You're going to pay a premium, and that premium is naturally going to decrease over time. And theta is the decrease of that premium over time. It's time decay. You have vega, which is volatility, all right? And this is a 1 point or a 1% change in implied volatility, how that affects the spread price. Essentially, as volatility goes up, the extrinsic value of your spreads goes up, all right, at the floor and the ceiling, and they'll go up the most. And you'll learn how theta and vega, or time decay and volatility, are very similar concepts. So if you understand one, you're going to understand both of them. And those are the major Greeks we're going to get into. And yes, because there are more Greeks that you apply to options, especially longer term options, like, you know, people have heard of rho, which is based off interest rates. We don't need to worry about something like that for spreads because A, you're trading spreads intraday, and even if it's on a day of a rate hike or cut, it's not really going to change your spread price at all. It's going to be so minuscule you'd never even notice it. So we don't have to touch on stuff like that. And there's derivatives of the derivatives and how, which we don't have to go into. But you will, once you will also learn by understanding the Greeks, and you also understand how a spread should behave. Because spreads, you can also get skews in spreads. You can get, you know, it might behave a little differently. Remember, there's market makers making these spread prices, and I was a market maker for years. And based off a market maker's position, they might adjust a skew. They might adjust a volatility skew. They might actually adjust the spread price. And you'll start to see how there's deviations of this. You can sort of even sometimes guess the way a theoretical spread should be priced, and then you start seeing something in the marketplace, and you're saying, hey, well, that's not exactly priced the same way, and you'll understand why because of sometimes the market maker's position. So we'll get into all that. That's in a future webinar.
Okay. Well, I think there really are no more questions. We have had just tons of thank yous, and everybody has been very just loved the webinar. And actually, I think next week it's Tuesday, but we will be doing a email blast on when this webinar is coming out. Actually, hang on a second, guys. There's a lot more incoming. 1 second. Okay. Well, it looks like that's pretty much a wrap-up, unless you guys have something else to say here. Very informative. Thank you so much. Everybody loved it. So
again, thanks for having us to Nadex, and thanks to all you guys for sticking around. Again, please don't be intimidated by some of the terminology at this stage. Okay, what we're going to get to the point of is that light bulb moment, and we're going to get there very quickly where these terms don't scare you anymore. And you're going to flood into the spread markets, and you're going to find trades you couldn't see before. So we're looking forward to getting through these. I'm giddy to get home and actually be able to do this in United States Wi-Fi. So.
Oh, Bob, are you going to be back or still in Colombia for the next week?
No, I will be back, and honestly, I love Colombia. I love South America a lot. I love it here.
Okay.
But I need the reliable Wi-Fi in order to do these things the way that we can. So I will be back.
All right, excellent. Well, you're coming in loud and clear, that's for sure. And this is really great. And Mike, thank you for all your knowledge, Mr. Market Maker. So anyway, great. Look forward to next week then.
Cheers, guys. Thanks for being here.
Thanks for having us.
All right, take care.